Okay. Hi, my name is Chris Strickland. I'm the CEO and co-founder of Lacima, and I have a presentation here on gaining a competitive advantage and managing your risk in the LNG trading area. So there have been a number of discussions in the conference yesterday and also earlier this morning about what's been happening in the LNG market, so I don't think I need to dwell on it. But a brief discussion provides context to the discussion that we're going to have here. So price and volatility in LNG and pipe gas has been at record high levels. This covers pretty much every major hub globally. The position is likely to deteriorate into the northern winter, with consensus that the risk is very much to the upside. We're expecting increased prices and increased volatility. As this graph shows for TTF, JKM and Henry Hub, we've seen a doubling and tripling of prices over this past year. In Asia, there's high demand for LNG, especially in China. Post-pandemic manufacturing boom has been creating demand which is roughly 40% higher over pre-pandemic 2019 levels. Japan's warm summer has pulled in a lot of gas to fuel air conditioning demand, and Asia is competing with Europe. Europe is currently in a dire situation. The headline on CNN Business this morning was Europe is paying a record price for energy, a winter crisis looms. Prices have tripled over the past year. Gas stocks, as the top right-hand graph shows, are at decade lows. There's been high gas power generation needed to compensate for low wind production. Supply from LNG, Russia and local fields are all at all-time lows, some of it due to the maintenance being performed on assets that was delayed previously due to COVID. And as the headline on CNN suggests, this situation is likely to deteriorate into winter. In the US, prices have doubled, high LNG exports, low stocks following high aircon demand over the summer, low production in the Gulf of Mexico post-hurricanes, and again, the risk is to the upside, with the US in the middle of hurricane season. So what does this mean for LNG trading businesses? At these trading levels and volatilities, there are huge opportunities to make money, especially around embedded flex terms and other embedded optionality in the kinds of LNG structures that we see nowadays. Individual flex terms can contribute over, $1 per MMBTU, and we've seen them up at $5 contributions at these levels. So with large deals, multi-year strips of multiple cargoes a year, this can lead to tens, hundreds of millions of dollars of value. The flip side of that, obviously, of all this volatility is risk. And so it's essential to understand and manage the risk associated with individual deals, portfolios, and businesses effectively. We've seen over the last 10 years what can happen by not managing risk effectively. It can result in large losses and businesses shutting down. So that market context presents significant opportunities as well as risks for LNG trading businesses. Over the past few years, the most successful LNG companies have used analytics to monetize opportunities, deliver value presented by these changing market dynamics, while actively managing and mitigating the risk. And we've identified 4 key areas where analytics are implemented to gain a competitive advantage in this market. The first is deal analysis. How to measure the values associated with the individual flex terms of an LNG structure. As we'll see on the next slide, these flex terms include location flex, delivery window, pricing basis, swing components on the volumes, the ability to cancel cargoes, extend contracts, the ability to sellers to push extra cargoes, and others. Second component is portfolio analysis. This takes that deal analysis up a level and looks at how individual deals mesh or influence the wider portfolio, which might contain kinds of LNG structures that I was talking about in deal analysis, as well as standard hedge instruments. The next quadrant, shipping optimization, looks to find the optimized shipping schedule to match lifts and deliveries that maximizes value. And then fourthly, risk. Being able to effectively identify, quantify, and manage the risk is key to first attaining and then maintaining a competitive advantage. Ideally, all of these analytic disciplines would be underpinned by a single application with a common numerical engine, which is being used by all of those different components. So I'm now going to go on to look at the individual quadrants. So deal analysis. Individual deal analysis involves capturing the payoff, exercise and nomination conditions, and any associated constraints, and modeling the key variables that are driving the uncertainty through time. With LNG companies, the roles typically that are employed for this type of analysis are structurers, originators, quant analysts, portfolio optimizers. All the major players are able to value these key flex terms. The locational flex, delivery window, flex on the volumes, swing components embedded in upwards and downwards quantities, pricing basis, cancellation options, etc. So in the waterfall diagram on the right hand of this slide, we see a number of comparisons. The first bar is the intrinsic value assuming no flex, and there it's got a negative value. We're selling at a higher price than we're buying, but the gas, we don't have any option to get out of it. The seasonal flex, you might have the option to be able to take 6 cargoes in a year. You choose the best 6 months. Volumetric flex, there's a volume associated with the contract, but you can flex that up and down by plus or minus 5%. The buyer might have the option to cancel a cargo. Maybe the contract looks at buying 11 cargoes a year, but you can cancel up to 3 at the buyer's option. It could be diversion flex. So you can sell the gas in Europe at TTF or in Asia at JKM. It could be pricing basis flex. You can buy the gas at 11% Brent or TTF plus $1, again at the buyer's option. Often there's a seller's option. So the seller might have the option to increase the cargoes by 1 in a year. That's UQT flex. So we can attribute value to these individual flex components, and that gives us an understanding about what kinds of flex have what kinds of values. But it's really the combined flex of the deal that we're predominantly interested in. The flex terms together are worth more than the sum of the individual flex terms. Embedded in the example I've just been given, the option to pay TTF is only worth something when combined with the option to divert the cargo to Asia. Secondly, all the sophisticated players would look at the key value drivers, sometimes called the risk sensitivities or the Greeks of the deal. The graph on the right-hand side here shows the deltas by month for the key risk factors in the deal that we've been looking at. The delta exposure is negative for the costs, that's the blue bars. Pay Brent to buy gas, pay shipping to ship gas, and delta exposure is positive for the revenues. They're the red bars. So you receive TTF or JKM dependent on which port has been chosen for delivery. In addition, the deltas on the revenue legs give you a rough probability to which gas hub the gas is going to be delivered. So we go back to sort of classical option pricing theory. These hedge ratios and probabilities allow the sophisticated players to monetize the volatility of the options. So the valuation methodology that's typically employed here, Monte Carlo simulation, you not only get the value of the option as the mean of the distribution, but you get the full characterization of the values. And you can use this to analyze both the upside potential and the downside risk. The graph here on the right-hand side shows the comparison of the impact of adding flex terms to a deal. The orange curve, if you like, is the deal with no flex, and the blue curve is the deal with the flex terms introduced. The effect of this example is that the flex terms induce positive skew. So we're increasing the positive outcomes, but they're removing the downside risk. And as I've mentioned before, for multi-year strips of cargoes, we're looking at tens, hundreds of millions of dollars of value. The second component is portfolio analysis. This takes the individual deal analysis that we were just looking at up a level. We're looking at the effect of the deal on the wider portfolio. That wider portfolio might contain an ADP, short-term trading book, a long-term structuring book, or even a ring-fenced asset. The roles within an organization that typically implement this type of analysis: portfolio managers and optimizers, the shipping team, structurers, and strategists. One of the key utilizations of analytics here in this context is to slice and dice revenues, values, costs in various different ways. This example, it's broken down into monthly cash flows attributable to various ports, but we might be also looking at slicing the results by different counterparties. I have a colleague that always says that the major players gain insights by taking a base case and running scenarios. So often major strategic questions are considered. What's the effect of selling different amounts of a new production train on a spot basis or under a long-term contract? What's the effect of buying storage capacity in Singapore? What's the effect of acquiring 2 vessels on long-term leases on the overall portfolio? Or as we have here, how does the value change with a sharp drop in the crude price? Or what's the effect of selling various percentages of a train on long-term DES contracts versus selling spot FOB? Another key set of insights comes about by comparing various hedge scenarios. What's the effect of hedging the physical LNG portfolio with various hedge instruments? Here, the blue line in the diagram is the portfolio unhedged versus the hedge curve, which is the red one. The tighter distribution of the hedge portfolio shows the level of risk reduction with the cost of the hedge implied by the lower mean. The third category is shipping optimization. This looks to take a description of the full physical detail of an LNG portfolio and finds the optimal value, shipping schedule, physical dispatch of the portfolio. The physical details of the portfolio should look to include as many of the major physical features and constraints as possible. So, for example, users typically look to include sales and purchase contracts, the associated lifts and deliveries, vessels and associated properties such as fuel speed, boil-off rates, insurance costs, charter rates, port and market properties such as loading, discharge fees, etc., canals, timings, and costs. The goal of the optimization routine is to provide the optimal portfolio decisions that deliver the most value while meeting all of the constraints of the portfolio. So in terms of the outputs, the figure here shows the P&L of the top 3 optimal solutions ranked by value, as well as the description of the voyages taken by each ship. By deriving the optimal and suboptimal solutions, trading teams can analyze the implied shipping schedules dispatch and nomination decisions of each of the solutions to understand the key differences between them. From these optimal solutions, users gain insights into the key areas like value attribution by counterparties and ports, the optimal flows, can visualize the flows implied by the optimal solutions in a Sankey diagram. And again, scenario analysis is key. As we've said, these businesses are highly material. Portfolio shipping optimization is a critical activity and is typically used in three areas: short-term optimization out to less than, say, 12 months, long-term portfolio and shipping optimization up to 30 years, and annual delivery program planning. The highly material nature of the trading operation means that any slight improvements can add millions of dollars of extra value. So having access to a comprehensive and accurate portfolio and shipping optimization tool is able to capture the full physicality of the LNG portfolio has a considerable value and is business critical to many LNG trading teams. Okay, my final quadrant is risk. Many pure trading shops tend to focus on value-based metrics like VAR, but this metric gives very little insight into the uncertainty of earnings that accrue to the physical side of the business. So for many organizations, cash flow-based metrics like earnings at risk or revenue at risk are more applicable. These take into account equity positions, cargo sales and purchases, flexible sources and delivery points, and all these other aspects that I've been talking about that are relevant to LNG portfolios, but impossible to represent accurately in a VAR metric. Producing the number is probably 20% of the battle. Having insights into the number that's produced, my value at risk is $6.5 million, is the other 80%. Risk groups typically spend their whole day trying to answer the questions about how has the value changed since yesterday. We've got one value, we trade 300 curves, we have 100,000 deals in the portfolio, physical, financial assets. How can you explain that? How can you dive down into that? So you need to be able to identify the key drivers and the hotspots of risk. Most users want to be able to look at potential trades. How do they add or distract from the risk profile and how much? And lastly, this is something that came up in the last session. How can I see a single view of risk across my entire portfolio from potentially different systems? You've got different gas systems in different markets. You've got a physical LNG system because the ETRMs are not very good at handling the physical nature of LNG. Having a single risk engine that sits across the top of those is key. Okay, I've been given the message that I need to wind up. Thank you for your attention. My talk today is based on analytic solutions that we've implemented for our clients. Very happy to announce quickly that we were recipients of 2 major awards as part of this conference. Innovation of the Year, which is for our LNG shipping optimization, and Data and Analytics Firm of the Year. So if you'd like to find out more about any of this, please contact me or connect with any of my colleagues via the conference portal. Thank you very much.